the audit sampling lecture. This is the fourth in a series of 4. So I hope you've watched 1, 2 and 3, the first to the third session. If you've not watched 1 to 3, please make sure that you go and watch 1 to 3. Alright. Okay, so we've defined sampling, we've done attribute sampling in terms of test of controls, and we've done an example of how to do attribute sampling with regards to test of controls. Now we're moving on using monetary unit sampling. If you remember, in the second session, I said that in terms of sampling, what is examinable is the attribute sampling and the monetary unit sampling. And so we then covered attribute sampling. Now we're covering the other type of sampling which is going to be examined, which is the monetary unit sampling. So this is what we want to get into now. So in terms of monetary unit sampling, what is it? So it uses attribute sampling theory. What we're doing in the sessions 1 to 3, that theory that we covered, to express a conclusion in monetary amounts. So it could be e.g. in dollars and rands or any other currency that you might be using, rather than stating the rate of occurrence, where we're saying attribute sampling looks at a document or looks at maybe a receipt, an invoice or something like that. So in terms of your monetary unit sampling, it's commonly used by auditors when they want to test things like the accounts receivables, loans, etc. So you find that the monetary unit sampling, as I said, it uses the theory that we covered in attribute sampling, but now it's using it to also estimate the percentage of monetary units in a population that might actually be misstated. So now we're using monetary units in the population and not documents in the population, as we're doing with attribute sampling under test of controls. And then what it then does is, what the monetary unit sampling does is then after testing the units, the population for misstatements, the monetary units for misstatements, it then multiplies the percentage by an estimate of how much the dollars or whatever currency you're using are actually misstated. So if you look at the steps that you take, as we said, because it uses the same theory as in attribute testing, as attribute sampling, you find that the steps are just the same. Firstly, as with your attribute sampling, with your monetary unit sampling, you also determine the test objectives. But we'll go into detail to say now what are the objectives. And then we define the population characteristics, just as we did in attribute sampling. And in defining the population characteristics, again, you also define the population. After defining the population, you define the sample unit and you define the misstatement. So now in this case, we're now defining the misstatement instead of defining the deviation, as we're calling it in the attribute sampling with test of controls. Now we are saying what is a misstatement, because it's a monetary unit. So we're looking for the misstatement. And then the third thing that we do, we then determine the sample size by using, firstly, the desired confidence level or the level of risk of incorrect acceptance, just as we did with our attribute sampling. And then we're also using the expected population misstatement now. Remember, at that time we're using the expected population deviation, but now we're using the expected population misstatement and the population size. And in terms of performing, we're selecting the sample items, and after we've selected the sample items, we then perform our auditing procedures on the selected sample items. After that, we then have to evaluate. And in evaluating, we calculate the projected misstatements and the upper limit on misstatements. And finally, we then draw our conclusions on whether our population is misstated. So let's get into a bit of the details as to what is it that we're doing now. In terms of determining the test objectives, the test objectives in a monetary unit sampling there could be two. So it could be, firstly, where you're testing for misstatements or reasonableness of the assertions about a financial statements item or an amount. That is to say, is it fairly stated or is it not fairly stated? And it's common used in when we're sampling for the purposes of substantive testing. Or you're also using it to develop an estimate of some amount that you're trying to come up with. Moving on with our planning, when we've determined the test objective, is it for the assertions as we discussed, or is it to come up with an estimate? The next thing that you have to do is to define the population characteristics. So you find that for the monetary unit sampling, the population is defined as a monetary value. And the monetary value of, let's say, an account balance, which could be your receivables or which could be your investments, etc. So, but however, in this case, what is key to note is that the population is defined in terms of the monetary value. Now, the sampling unit. The sampling unit is defined as, or is represented as, the dollar amount, the dollar itself. The population is the dollar value, the monetary value. The sampling item or the sampling unit is the dollar. So each dollar in the population becomes a sampling unit. And then the misstatement now. How do we define the misstatement? So you have to then define your misstatement with regards to your sample. And a misstatement is normally defined as the difference between what is in the client's records and the amount that is supported by audit evidence. That is what we call a misstatement. So let's just have a brief overview of the relationship of the desired confidence level, the tolerable misstatement, the expected misstatement, and the population size on the sample size. So you find that with your monetary unit sampling, your desired confidence level, which is determined by the level or the amount of assurance, the level of assurance that you actually want to express, there's a direct relationship. So when there's a high level of assurance that you want to express, you find that the sample size will increase. And the opposite will be true. Where there is a lower level of confidence that you want to express, then the population or the sample size will be lower. It will decrease. With regards to your tolerable misstatements, there's an inverse relationship. Where you want a lower tolerable misstatement, you find that your population size, your sample size will need to increase. And where you want your population will increase, your sample will increase, and where you want a higher tolerable misstatement, where you're willing to accept more misstatements and still conclude that the population is not materially misstated, it's fairly stated, then where you're willing to accept a higher tolerable misstatement, then the sample size will decrease. With regards to the expected misstatements, there's a direct relationship. Where you're expecting a lot of misstatements, remember we said the expected misstatement could be from experience of the auditor. To say, when I'm dealing with receivables, I expect this much of misstatements within that population. But when I'm dealing with maybe revenue, when I'm dealing with my investments, I expect maybe a different amount of misstatements. So your expectation is based on your level of assessed risk, it's based on your experience, So you find that in that case, where you're expecting a lot of misstatements, so where the expected misstatements are lower, you decrease your sample size. But where you're expecting a higher level of misstatements on a population, you then have to increase your sample size of that population. And lastly, the population size. Remember we said when we're doing attribute sampling for test of controls, we said that the population size does not really have an effect on the sample size unless if the sample is less than 500. But now, with regards to your monetary unit sampling, there is a direct relationship. You find that the lower the population size, the smaller the sample size. The higher the population size, the higher the bigger or the increase in the sample. So we move on with now, at this stage we now want to perform and evaluate. So you find that with your monetary unit sampling, the auditor then selects the sample, and by so doing they then have to use a systematic selection approach. And this approach that they're using to select is called the probability proportionate to size selection. That is the selection method that you'll use when you're using the monetary unit sampling technique. So the sampling interval can actually be defined or determined by dividing the book value or the value of the book, it could be 2.5 million, by the population size. Maybe the population size is 500. So you divide to get your sampling interval. And then you find that each individual dollar in the whole population has an equal chance of actually being selected, where you use the probability to proportionate size of selection. You also find that obviously, logically, because each unit, which is each monetary unit, which is each dollar, has an equal chance of selection. Those amounts, let's say debtors with higher amounts, are going to have a higher chance of being selected. That's a logical test, because every dollar is representing a unit. So let's look at a small example, and on our screens we can see a small example. So assume that a client's book of accounts receivables is later say 2.5 million, and the auditor determined a sample size of 93. What will be our sampling interval? Remember we said to get our sampling interval, we then divide the receivables amount divided by the sample size. So we divide 2.5 million by 93. And the random number that will be, so the first number can be picked randomly. So in this case, the auditor would have picked randomly, let's say remember the unit is a dollar. So we're going to look for that dollar, that is the $3,977. So it's not going to be in our account one, which is ACE Emergency Center, because ACE Emergency Center has accumulated amount of $235. So the dollar which is sitting at 2,350, that dollar is not falling under the dollar that we want to select, that we chose to select randomly, which is the $977. So we go to the next account, and our next account is Addington Hospital. And cumulatively now, if we add the amount owed by ACE, which is 2,350, and the one that is owed by the hospital is 15,495. When we add the two cumulatively, our amount is now sitting at 17,845. And in that amount, that is where we find our $977. So that is our sample number 1. Our sample number 2, we're going to use our sampling interval. 2.5 million divided by 93, which gave us 26,882. We then added to the randomly selected first interval, first dollar that we tested. When we add that, we get 30,859. We go and look on our table cumulatively. Where is that dollar sitting at? The 859th dollar, 30,859th dollar. Where is it sitting at? You'll find that it's now sitting at Good Hospital Corporation. So we then select that. And we do it repeatedly until we get to the final amount. That is how we then select our items to be tested. Once we've selected, we now want to perform our procedures. So you will have then determined, based on your risk assessment, you will then have determined the procedures that you'll be carrying out on these samples. Then you then perform your audit samples on the selected monetary units, which are your selected dollars. Next now is we evaluate. And in evaluating, what is it that we're going to do? So the misstatements that would have been detected when you were then now carrying out your tests on those selected samples, you then document them and you write them down. So let's look at an example. So our example says we've got a book value of 2.5 million. Our tolerable misstatement, the auditor will have determined to be 125,000. The sample size was determined to be 93. The desired confidence level, 95%. Expected amount of misstatements within the population was set at 25,000. And the sampling interval, 26,882. And I'm sure you saw how we came up with some of these figures. So in our example, the thing that the auditor has to do finally is to determine whether or not the accounts receivables are materially misstated. So what do we have to do to determine that? We then will need to compare the tolerable misstatement to the upper misstatement level. If the upper misstatement limit is less than or equal to the tolerable misstatement, then we can conclude that the accounts receivables are not materially misstated. But if the opposite is true, whereby the tolerable misstatement is actually lower than the upper misstatement limit, then the accounts receivables will be considered to be materially misstated. So in our example, the upper limit is 150,621, which is greater than the tolerable misstatement, which was set at 125,000. So in this case, the auditor will then conclude the accounts receivables to be materially misstated. But what is it that the auditor has to do when they realize this from their sample? So the auditor can decide maybe to increase the sample size. Because remember, there is always sampling risk. So maybe they increase the sample size to see, okay, maybe it could have been that the misstatements are sitting just from the sample that the auditor picked. So they can increase the sample size and carry out the test that they deem fit, or they carried out on the sample which they used to come up with the conclusion in the first place. The next thing, as I said, is to perform other procedures that they can carry out. Maybe they'll need to expand on the procedures that they had determined to carry out in the first place at planning stage. Or they could also request the client to adjust the accounts receivables amount. And this they will do, especially if they find that even after having increased the sample size, the conclusion is the same. And after having performed other procedures, the conclusion was still the same, that the accounts receivables were materially misstated. So the auditor will then communicate to the client to adjust the accounts receivables so that they can be reflective of what the audit evidence is showing. In the event that the auditor refuses to adjust the account balance, the auditor will need to consider whether to qualify the financial statements, to qualify their opinion, to issue a qualified opinion, or to issue an adverse opinion. Now, what are our next steps with regards to sampling? Sampling is not one of your easiest topics. So we recommend that you also go back to your modules, read on sampling, attempt the online quiz that will be given to you, attempt questions that are in your modules, and identify any issues that you might have, so that when you come to the lecture, to the block lecture that will be the physical contact session on sampling, you bring your questions and we address them there. For any further questions that you might want to ask, you can use the listed email addresses. If you're going to use the auditing email, it's recommended that you also copy any one of the individual emails from the team members. Okay. Thank you very much. That is all from me.